Today, we're looking at a fertilizer market that's being pulled in two directions. On one hand, geopolitical tensions in the Middle East, tight global supply, and ongoing logistical disruptions are supporting prices. On the other, weak fertilizer exchange ratios and the risk of demand destruction are starting to weigh on the outlook. I'm Johanna Bota, and to discuss this, I'm joined today by Tomas Pernias, Brazil Market Intelligence Analyst at StoneX. Welcome back, Tomas. Always good to see you.
Thank you. Glad to be here.
Thomas, let's start with this. The second quarter buying window, which is typically very favorable for buyers, is now at risk. Why is that happening this year?
Fundamentally, this is a risk related to the war in the Middle East and all its consequences for the global fertilizer market. First, in the days that followed the conflict, several producers in the Middle East experienced some kind of disruption, whether due to a lack of natural gas, damage to production facilities, or insufficient storage capacity to accommodate a production that could not be exported. Second, logistical constraints caused by the closure of the Strait of Hormuz created this major choke point in the global fertilizer market. This navigation route is crucial for nitrogen, phosphate, sulfur, and gas exports from Middle Eastern countries. So this means that a global supply was and still is significantly reduced given the importance of the region in the global production. And even if a peace deal is reached within the next few days, and even if the Strait of Hormuz becomes the safe route for ships in the short term, investors expect it may take several months for the fertilizer market to regain something close to normal conditions. And this means buyers may face a challenging scenario in the second quarter. Sticky prices, limited room for discounts, and a tight supply are conditions likely to persist in the coming weeks. And even though buying pressure usually eases this time of the year, the chances that buyers will encounter attractive prices or very favorable fertilizer trade ratios are very low now in 2025. So buying the dip in the second semester may not be a strategy after all, as geopolitical tensions and the consequences of the war are still expected to persist throughout this year.
Okay, so tell me what you're seeing right now then. How are geopolitical risks and logistics shaping the fertilizer prices right now?
Geopolitical and logistical factors are the main issues right now in the fertilizer market. Middle Eastern countries are responsible for roughly 40% of global urea exports and a significant share of global ammonia, DAP, and sulfur supply. However, since the start of the war, the Strait of Hormuz has become this choke point, and the market has lost a large portion of Middle Eastern supply. There are a few exporters, such as Saudi Arabia and Oman, that have ports outside the Persian Gulf and are therefore still able to ship their cargo. But this is not the reality for many other countries in the region, such as Qatar, which are facing a complete blockade of the navigation outside the Gulf. And let's not forget that the war has also increased transportation costs. We're facing higher shipping costs, we're facing higher insurance costs, and lower vessel availability. So this scenario has created this chaotic situation in the global fertilizer market and enormous challenges to clear all the bottlenecks related to the war. And it's important to emphasize that the end of this conflict, unfortunately, will not immediately result in the end of the logistical constraints we are experiencing right now.
So what do you think is the outlook then for nitrogen fertilizers, which have been badly hit, and where could opportunities emerge?
When we talk about nitrogen fertilizers, we are dealing with more volatile prices. So this is a market characterized by fast price moves. This is a market characterized by fast price movements. So there is a chance that if the US and Iran reach a durable peace deal, prices could soften. And in this case, this would be good news for the buyers that need nitrogen for the second semester. However, we must also remember that if the Strait of Hormuz closure persists, this could represent a worst-case scenario relative to what we are seeing right now. This would increase uncertainty around global supply when buying pressure reemerges in the end of the year. And in addition, natural gas prices are likely to remain at elevated levels if peace negotiations fail to advance. because higher input costs for the nitrogen industry are expected to remain a concern as logistical constraints will persist for several months regardless of the ongoing negotiations.
So then why is the phosphate market expected to remain particularly tight?
The phosphate market is characterized as a less volatile market with a supply that responds more slowly to short-term changes. And this is why there's a very low probability that buyers will face more attractive prices in the short term. And also, even before the war, the phosphate market was already described as a segment where global supply was tight and prices were elevated. We're talking about a market in which buyers have been struggling for months with poor fertilizer trade ratios, constantly searching for ways to minimize production costs. So even if conditions normalize in the Middle East, the best case scenario would be a gradual return to a situation that was far from ideal for buyers. And again, if logistical issues persist for several months, prices will remain firm. And let's not forget as well the impact that higher costs for ammonia and sulfur, key inputs exported by Middle Eastern countries, are having in the phosphate segment. Mm-hmm. The current scenario suggests that demand destruction is now highly likely across several markets.
How does the potash market compare and what uncertainties remain?
Compared to the conditions we are seeing in the phosphate and nitrogen segments, potash prices and trade ratios offer some relief for buyers as MOP buying conditions are currently more favorable. However, there are some obstacles in this segment as well. There is a chance that buyers will prioritize purchases of phosphate and nitrogen products, paying less attention to MOP negotiations and applications. And as a result, tighter conditions in the broader fertilizer market may eventually affect the potash segment as well, even though this specific product is less impacted by the conditions in the Middle East.
So then what are you seeing as the key risks for farmers and global agribusiness in this environment?
Farmers will face a difficult trade-off. Buyers who need fertilizer for the second semester can, for now, postpone negotiations. However, farmers cannot delay purchases forever.
Right.
Eventually, buyers will need to choose between accepting higher input costs and lower margins, or reducing applications and facing the risk of lower yields. There's also a possibility that farmers will face lower yields and lower margins at the same time. Mm-hmm. So in 2026, producers who closely monitor risk management and cost control will have better chances of maintaining an edge in this market. However, depending on the conditions that emerge over the next few months, cost management alone may not be enough to sustain positive results in this business. And this is especially relevant considering higher borrowing costs expected in 2026, as the war in the Middle East has reduced the likelihood that central banks will be willing to cut interest rates this year.
Understood. Tomas, thank you so much for all that insight, and thank you so much for joining us. And also a big thank you to our viewers for watching. If you want to learn more on what to expect in the commodity world these next few months, I encourage you to visit our platform using the QR code on the screen. See you next time.